First up, literally no one in the world, not me, not you, not Jane Street, not Citadel, nobody knows what the outcome of a single trade or a single investment is going to be. Second, there is no free lunch. And how I like to say this, you don't get something for nothing. If you want to chase very high returns, you're going to have to assume more risk. You don't get something for nothing. And lastly, and probably most importantly, insane wealth is built incredibly slowly and over time. If you want a lottery ticket, this isn't the field for you. The problem is, we don't have these values in a forward looking sense. We only have them in a backward looking sense. But these measures here, they're backward looking. This already happened. It's really important to first understand that more risk does not necessarily mean more return. So you took on significantly more risk, measured risk by the standard deviation, but you did not achieve more return. So what you're seeing here is effectively the outcome of this idea that more risk does not mean more return. Just because you assumed more risk in this AI startup, it does not mean that you are going to achieve a greater return, especially in the long run. Let me tell you, the efficient market hypothesis is a great idea, but I think it entirely poisons an entire generation of students in university. Every single time they go through a finance program or some sort of applied math program, they seem to assume that everything is just immediately priced in to the markets, when that just is not fundamentally the case. No, no, no. I want you to understand right now, none of these are correct. None of them are. None of these forms are objectively correct. None of these forms are true. It's an academic exercise. Most importantly, without counterfactuals, trading and investing is just going to be poker at best. This is what I meant earlier on when I said that the entire space is statistical at best. Without a crystal ball, nobody knows what's going to happen. All that is to say, we can never prove that we were right. Can't do it. Can't do it. It's really mostly just about positioning and survival. And most of my content that talks about the actual positioning and survival, it gets almost no attention on YouTube. You talk about day traders and you slam their BS results and that gets a ton of attention, but you actually contribute some value to allocation and optimal risk allocation, and it's crickets. It's crickets. Our goal is positioning and survival. We don't know what the outcome of any one particular trade or investment is going to be. Our goal is never to just predict with an indicator or a strategy. It's positioning and survival. The efficient market hypothesis is just wrong. There's plenty of opportunity to generate wealth in the market. It doesn't mean that it's correct. And without counterfactuals, we're never going to be able to predict anything or even discern if our predictions or thesis or strategy is what produced a particular return. Instead, it's about statistics, operating as the casino, being the house, having a distribution with an edge, and accumulating that edge over time. When it comes to assessing strategies and portfolios, you have to remember that everything is backward looking. Nothing is going to tell you how it performs in the future. All of this information, expected return, volatility, standard deviation, is based on the past. It does not indicate what is to come. We don't get to pick which sample path we walk. We have a lot of problems, a lot of challenges that we face in reality. So when we look at these performance metrics, how should we think about them? Sharpe ratio, Sortino ratio, measures of risk-adjusted return, right? They tell us different things. They effectively tell us for each unit of risk that we take on, how much return do we get? For each unit of downside risk we take on, how much return do we get? Max drawdown. What is the worst loss that we would have had to experience in an unrealized capacity along our equity curve? CAGR, compound annual growth rate. If it was a smooth ride, how much would we be compounding at? All of these give us information about the paths that we've walked. They don't tell us about the paths that we're going to walk. So now, understanding that, taking a look at where we're at and where we're going, forward looking, stepping up to the plate, How do we want to position our portfolio? We are not trying to predict anything. We are trying to position for our survival. Backtests don't tell us about the future. They tell us about what has happened so we can step up to the plate, allocate risk in an effective way, such that we can sleep at night and such that we are meeting our investment goals. That's going to do it for this video, the only video you need to understand investing. If you're targeting a role as a trader, market maker, quant, or you're just looking to grow and protect your portfolio in all market climates by applying quantitative strategy, Quant Guild has 2 crazy free resources available to you. When you get started, you can pick your track. You can always change this later. If you're looking to break in, head on over to the Quant Roadmap. Every topic in the right order that you need to know for success in different roles. You can select them here. It will tell you the exact breadth and depth of knowledge you need in each for success in interviews and the career as a whole. And of course, if you're looking to grow and preserve your wealth, you're going to want to run your own personal hedge fund. This isn't a day trading strategy. It's structure institutions use every single day to cut their downside risk in half, improving their overall long run return. I have a free quant research note available to you on this page for exactly what is going on. Link in the description below to Quant Guild if you're interested in these free resources.